the role of hedge funds in stock market volatility. Here are the lessons to be learned from this blog. Lesson 1. Hedge funds wield leverage, short selling, and derivatives to boost profits. But these tactics spike volatility in the Philippine stock market. Lesson 2. Past crises, like 1997 and 2020, show hedge funds can deepen Philippine market downturns with aggressive bets. Lesson 3. A hedge fund's loss can spark a domino effect, crashing the PSE as forced sales trigger widespread panic. Lesson 4. Filipino investors can shield portfolios by avoiding leveraged funds, diversifying globally, and using limit orders. Lesson 5. Staying informed about hedge fund activity and PSE trends empowers retail investors to outsmart volatility. Hedge funds and their influence on the Philippine stock market. Hedge funds, managing trillions globally, are powerful players that can shake the Philippine stock market. These private investment pools, reserved for the ultra-wealthy, use high-risk tactics like leverage and short selling to chase massive profits. In the Philippines, their actions can amplify volatility, especially in a market sensitive to global trends. For example, leverage borrowing fights to tanks their capital magnifies gains and losses, while short selling can spark panic among local traders. During the 2020 pandemic crash, hedge funds' aggressive moves deepened the Philippine Stock Exchange's PSE downturn. Derivatives and rapid-fire trading further destabilize prices, creating wild swings that catch Filipino investors off guard. Understanding how these giants operate is the first step to navigating their impact. This chapter unveils their role and why they matter to every trader in Manila or beyond. Risky hedge fund strategies, shaking the Philippines. Hedge funds deploy bold strategies that ripple through the Philippine stock market, often leaving chaos in their wake. Short selling borrowing shares to bet against them can tank stock prices if others pile on, as seen in global cases like GameStop. Leverage, sometimes exceeding tanks, turns small market dips into massive sell-offs when funds unwind positions. Derivatives, like options, let them control huge stakes with little cash, risking sudden shocks. High-frequency trading, with millions of trades per second, can trigger flash crashes in seconds. In 2021, a hedge fund short bet on a PSE listed stock sparked a volatile squeeze, rattling local investors. These tactics, while legal, prioritize profit over stability, making the Philippine market a roller coaster. This chapter dives into these strategies, revealing how they turn calm trading days into storms. When hedge funds rocked markets. Lessons for the Philippines. Hedge funds have a history of destabilizing markets, and the Philippines isn't immune. The 1997 Asian financial crisis saw hedge funds attack regional currencies, indirectly slamming the PSE as panic spread. In 2008, global hedge funds shorting mortgage bonds worsened the financial crisis, with aftershocks hitting Manila's markets. Closer to home, the 2020 COVID-19 crash saw hedge funds dump stocks en masse, driving the PSE Composite Index (PSEI) into a tailspin. While the Philippines hasn't faced a singular hedge fund collapse like Archegos, these events show their power to amplify downturns. Filipino investors felt the sting as portfolios shrank amid the chaos. This chapter explores these historical shakeups, offering a gripping look at how hedge funds' missteps or victories can send shockwaves through our market, urging vigilance for the next big tremor. The domino effect, hedge funds and Philippine sell-offs. Hedge funds can ignite a devastating domino effect in the Philippine stock market. When a fund's bet sours, lenders demand collateral, forcing sales of unrelated assets. These fire sales slash prices across the PSE, sparking panic among retail investors. In March 2020, hedge funds offloaded billions globally, dragging the PSEI down as local traders followed suit. This feedback loop losses, margin calls, sell-offs turns a single misstep into a market-wide plunge. For Filipino investors, this means 401k style savings or small stock holdings get hammered. Flash crashes wipe out stop losses, leaving traders exposed. This chapter unpacks this chain reaction, showing how hedge funds' high-stakes gambles can topple the market like dominoes, leaving retail players scrambling to pick up the pieces in a volatile, unpredictable storm. Shielding your portfolio from hedge fund chaos in the Philippines. Filipino retail investors can fight back against hedge fund-driven volatility with smart strategies. Skip over leveraged ETFs, opt for low-cost PSEI tracking index funds to stay steady. Diversify beyond the Philippines. Global investments dilute local risks tied to hedge fund moves. Use limit orders, not market orders, to avoid selling at rock-bottom prices during crashes. Keep an eye on short interest data for PSE stocks. High numbers signal a potential squeeze. In 2020, informed traders dodged losses by staying disciplined amid hedge fund sell-offs. Warren Buffett's wisdom rings true. When markets crash, the reckless get exposed. This chapter arms you with practical, Philippines-focused tips to protect your hard-earned money. Stay sharp, diversify, and trade wisely, because in a market swayed by hedge funds, preparation is your best defense against their turbulent tides.